In this video, we'll introduce you to the exciting world of Forex trading. Whether you're a beginner or looking to refresh your knowledge, understanding the basics and terminology is crucial for success in the Forex market. Today, we're diving into the fundamentals of Forex trading. Let's get started. Forex, short for foreign exchange, is the decentralized global market where currencies are traded. It's the largest and most liquid financial market in the world, with an average daily trading volume exceeding $6 trillion. In Forex trading, currencies are always traded in pairs. The first currency in the pair is called the base currency, while the second currency is the quote currency. For example, in the Euro-USD pair, the euro is the base currency and the US dollar is the quote currency. There are three main categories of currency pairs: major, minor, and exotic. Major pairs consist of the most traded currencies globally, such as EUR-USD, GBP-USD, and USDJPY. Minor pairs, also known as cross-currency pairs, don't include the US dollar like EUR-GBP or IUDJPY. Exotic pairs involve one major currency and one currency from a developing economy, such as USDTRY or USGD. In Forex trading, you'll encounter two prices for each currency pair: the bid price and the ask price. The bid price is the price at which the market will buy the base currency in exchange for the quote currency, while the ask price is the price at which the market will sell the base currency in exchange for the quote currency. The difference between the bid and ask prices is known as the spread. Understanding bid and ask prices is essential because it allows traders to execute buy and sell orders effectively. The bid-ask spread represents the cost of trading and can vary depending on market conditions and liquidity. Another important concept in Forex trading is leverage. Leverage allows traders to control larger position size with a smaller amount of capital. However, it's essential to use leverage cautiously as it amplifies both profits and losses. Margin, on the other hand, is the amount of money required to open and maintain a leveraged position. Margin requirements vary between brokers and depend on factors like the size of the position and the leverage used. While leverage can enhance trading opportunities, it also increases risk. It's crucial to use risk management tools like stop-loss orders and proper position sizing to protect your capital. To recap, Forex trading involves buying and selling currencies in pairs, with major, minor, and exotic pairs available for trading. Understanding bid and ask prices, leverage, and margin is essential for navigating the Forex market effectively. That concludes our introduction to Forex trading basics and terminology. Stay tuned for more educational content on our channel.
Thank you so much for watching this video. My name is Tayo. This is BillBridge. If you are new to BillBridge, kindly click the subscription button and turn on the notification bell button to be the first to know when we post useful and helpful videos on this channel. Once again, my name is Tayo. This is BillBridge, and stay profitable until next time.